We all know how the greediness of the big banks caused the 2008 financial crisis.
2008 was a tumultuous year for the economy. The housing market collapse created one financial crisis after another.
It is definitely a very, very difficult time, and it's not going to get better quickly.
When Lehman Brothers got in trouble, the thinking was just let it fail. That was an enormous shock to the system. Others were in trouble as well. One by one, we learned that major financial institutions, some of the largest lenders in America, had made bad loans, bundled them into securities that were virtually worthless, insured them with companies that couldn't stand behind the insurance, and in the end, the federal government had bailed them out because we need these big banks to keep the economy going.
These banks were unaware of the potential crisis their greed would cause. Just before the 2008 financial crash, when these investment banks realized that they were going to incur huge losses, the panic started, and how they handled the situation is shown in the movie The Margin Call. In one of our previous videos, we explained how and why exactly the 2008 crash happened. It is recommended that you watch that video first. If you liked the movie The Big Short, then you must have liked the movie The Margin Call as well. Investment banks make money by offering various services to their clients, which include offering suitable investment products and many other things. You can watch this video to learn how exactly an investment bank works. But before we go further, let's see what a margin call is. Many people might get confused as these two terms, margin and margin call, sound very similar. In the world of finance, margin means to borrow money. For example, if your broker offers a 10 times margin, and if you only have $100, your broker will lend you $900, and you can buy stocks worth $1,000. So, without margin, if you bought two $50 stocks for $100 and the stock value goes up to $75, then you made $50 in profit. But with margin, you can buy 20 $50 stocks, and when the stock value goes to $75, you make $500 in profit. Buying stocks on margin is known as leverage. When you borrowed too much money to buy stocks, it is known as over-leveraged. As the profits with margin are higher, the losses with margin are also higher. If the same stock goes to $25 from $50 instead of $75, then your loss will be $500. Not only did you lose your own $100, but you also lost $400 from your broker. You will have to pay $400 to the broker. Now, let's see what a margin call is. You have borrowed money from your broker, and the stock price is going down from $50 to $25. Your broker will notify you that you do not have enough funds to cover your losses, and he will ask you to deposit money in your account to cover those losses. If you do not deposit money, your broker can sell your stocks, close the position, and minimize the losses. This giving of intimation or asking customers to deposit funds to cover potential losses is known as the margin call. The movie Margin Call shows a situation in an investment bank when everything goes wrong. To appeal to a wider audience, the movie does not go into specifics about the numbers and financial terms. This is why, to understand this movie, you really do not need knowledge of finance. But while watching the movie, you know that their bank is in trouble and that something big is going to happen soon. Today, we will try to understand the movie with actual numbers. In the movie, the employee in the risk management department figures out that the investment bank is going to face huge losses, and it has already started. The company's higher management realizes the seriousness of the situation, and they all end up meeting with the CEO. The CEO asks Peter to explain the situation to him and everyone in the meeting. When Peter Sullivan starts explaining the real issue, he says,
Okay, well, as you probably know, over the last 36 to 40 months, the firm has begun packaging new MBS products that combine several different tranches of rating classification in one tradable security. This has been enormously profitable, as I imagine you noticed.
I have.
As an investment bank, it used to sell financial products to investors. One of the financial products the investment bank used to sell was mortgage-backed security. To create mortgage-backed securities, the investment bank used to buy loans from commercial banks. After buying these loans, the investment bank combined them to make a new tradable product known as mortgage-backed securities. Here is a small clip from our previous video to learn how the mortgage-backed security product was created. Let's say 10 people have taken a loan from ABC Bank to buy a house, and they owe money to ABC Bank. Now, what ABC Bank does is sell these loans to an investment bank. Now people owe the money to the investment bank. The investment bank combines these loans and creates new products known as mortgage-backed securities. In mortgage-backed securities, these loans are rated by rating agencies like Moody's. The rating is done according to the behavior of the borrower. It is called a tranche. For example, if a borrower pays the premium on time and never misses any premium, the probability of such a borrower paying back the loan is higher, so such loans are typically rated higher. These loans are rated as AAA loans. Another type of borrower might miss some of the premium here and there, but at the end he will pay back his loan. He may pay it a little late, but in the end he pays it back, and this type of borrower is slightly riskier than the previous type of borrower. So, such loans are rated a little lower. These loans are rated BBB. And the third type of borrower might default on his payments and not be able to pay back his loan. Such loans are rated lower, and they are rated as CCC loans. This MBS product was then sold to investors by these banks. Then, Peter Sullivan further says,
Well, the firm is currently doing a considerable amount of this business every day. Now, the problem, which is, I guess, why we are here tonight, is that it takes us, the firm, about a month to layer these products correctly, thereby posing a challenge from a risk management standpoint.
As their firm was buying random home mortgages from commercial banks to create an MBS product, it would take their bank about a month to combine these different loans, according to their ratings, into an MBS product. Peter Sullivan further says,
Well, we have to hold these assets on our books longer than we might ideally like to.
Yes.
But the key factor here is these are essentially just mortgages, so that has allowed us to push the leverage considerably beyond what you might be willing or allowed to do in any other circumstance, thereby pushing the risk profile without raising any red flags.
when you borrow money on margin, it is known as leverage. To create and sell this mortgage-backed security product, their firm bought lots of these loans from commercial banks. Before the 2008 financial crash, everybody thought the housing market was stable and wouldn't crash. So, the investment banks bought lots of these home loans to create an MBS product that was backed mainly by home loans. But, as the housing market began crashing, a lot of these home loans the bank bought were losing their value very fast. But it took almost a month to create an MBS product and arrange these home loans according to their ratings. So, if the bank held these loans for a month, they would lose lots of money as the loans were losing their value much faster. Usually, when these banks buy loans, they calculate the risk of such loans. But as all of these were home loans, they were considered a safe bet, and because of that, these investment banks borrowed and invested much above their risk limit. So basically, the firm was over-leveraged because of the huge borrowing on margin. Peter Sullivan further adds,
Those assets decrease by just 25% and remain on our books. That loss would be greater than the current market capitalization of this entire company.
how is this even possible? The reason for such a big loss with just a 25% decline is over-leverage. As explained earlier, if there's a higher profit with high leverage, then there are also higher losses with high leverage. Let's see this with an example. Suppose an investment bank, XYZ Investments, wants to buy $100 million worth of home loans to create an MBS product. But the bank only has $20 million of its own capital. The bank then decides to borrow an additional $80 million to create a mortgage-backed security product. This creates a total investment of $100 million, of which $20 million is their own money and $80 million is borrowed money. Now, let's revisit the scenario with a 25% decline in the market value of these loans. So, the new value will be $100 million minus 25% of $100 million, which is equal to $75 million. As the loans lost 25% of their value, the actual assets of the bank would be total investment minus borrowed capital minus the loss of 25% on loans. So, the new asset value will be $100 million minus $80 million minus $25 million, equaling negative $5 million. In this scenario, despite the $100 million total investment, the investment bank's capital is decreased to a negative $5 million due to the 25% decline in the value of mortgage-backed securities. Since the capital becomes negative, the firm's liabilities or debts are greater than the value of its assets, leading to a situation where the firm is insolvent. The losses have exceeded the entire capital of the firm, which means the value of the company has been wiped out and the firm is effectively worth less than zero. The bank in the movie realizes the potential crisis before everyone else in the market, so in order to survive, the CEO orders them to sell these loans with no swaps, which means they only want cash to sell their positions and nothing else. This is how the investment banks were overexposed and were on the brink of collapse just before the 2008 crash. One thing you will notice in the movie is that many of the top executives and management had an idea about the potential loss their bank would suffer. But the bank ignored that and still sold these products with huge borrowings because these products sold really well. If investors are ready to buy such a product, then banks would sell it to them. The movie itself says these banks do not lose the opportunity to make money, and they also do not lose money even if something goes wrong.
When all is said and done, they do not lose money. They don't mind if everybody else does, but they don't lose.
So, no matter what happens, these banks do not lose money. On top of that, the risk management department was given the least importance. They only focused on the positives and completely ignored the negatives and risks of their investment. Also, these banks would depend on the ratings given by the credit rating agencies. We already explained in one of our previous videos how the ratings given by the credit rating agencies were a fraud. Finally, in the end, the bank takes the risk, dumps its huge positions in the market, and saves itself. This is how most of the firms behaved just before the 2008 crash. During the 2008 crash, everybody lost money, but there were some people who predicted the crash and made huge profits during this crash. One such person was Michael Burry, and we recommend watching this video to know how exactly Michael Burry figured out the crash before anyone else.